that illustration number 2 is reworked out under provision for depreciation model. Based on the data given in question number 2, record journal entries and prepare machine account. So I will just pass the journal entry first of all. Yeah, purchase will be the same, right? 1st October 16 for the purchase 18 plus 20 2 lakhs. Installation charges will also be forming part of the assets value, and rate of depreciation being 10% and the method of depreciation being original cost method. But it is not going to be charged. It is not going to be charged in the asset account. The firm charges depreciation to asset account is not available here, but it is going to be accumulated in the provision for depreciation account. It is going to be accumulated in provision for depreciation account. Let's see here. On this date, at the time of purchase, the asset entry being machine account debit, to bank account. The value being 2 lakhs. Then next 110. Okay, 110. By the year end, 31st March 17, depreciation will be provided on this. Depreciation only for half year, because it's purchased only on 1st October to 31st March, it's only half year. 2 lakhs into 10% for half year you have to calculate. This value being 10,000. Usually the depreciation should be adjusted in the asset account, but here it is not so. Will be accumulated in the provision for depreciation account. As usual, the depreciation will be transferable to the P&L account. I am transferring that here. So profit and loss account debit to depreciation. The value being 10,000. This one is over. The next year repeat the same loss to entry again and again. That's all. 31/3/2017. Right. So I have a shortcut. I don't know whether it will be applicable for you. Is there such chances available for you? This is called cut and paste. Usually we'll do, sir, by seeing the friend's note. I'll change here. This is for 18. This value is 20. It's only cut and paste, right? This is for 19, 20. The same entry I am repeating, that's all. Is that okay? First year for half year, second year onwards it's for full year. Second year onwards it's full year. Isn't it? Full year means the full value of 2 lakhs. Okay. One second. 2 lakhs, and second year is fully used, 10% will be calculated, which is 20,000. Okay. Listen the lecture. I'll get back. Now let's see here. So first year amount of depreciation is 10. What is the amount of depreciation for the second year? 20. Third year? 20. The same I did. That amount is not going to be subtracted from the assets but accumulated in the provision for depreciation. If you prepare the ledger, you will understand. Let's see here. I am going to prepare the ledger. Its last two entry repeated again and again, similar to the other model. Only thing, the depreciation is not going to be charged to the asset account but accumulated in the provision for depreciation. Now the first one is machine account. First one is machine account. In machine, to bank. To bank. 2 lakhs. I don't do any other adjustment in asset account, so it remains the same year after year. Isn't it? It remains the same year after year. If you want to prepare, then you can prepare this way. First year 20, 2 lakhs. What is the closing balance? I don't pass any other adjustment here. So the year end, the value being balance carried on. 2 lakhs. This becomes the opening balance for the next year. Balance brought down. 2 lakhs. No adjustment carried over on this. So this becomes balance carried on for the next year. Isn't it? And third year, again it remains the same. In the beginning of the third year, 2 balance brought down. 2 lakhs. And this becomes balance carried on as it is. That's all. Because the amount of depreciation is not going to be adjusted in the asset account, the asset account will appear in the balance sheet as asset itself, full value. What about the loss of that asset, sir? That will be accumulated in the provision for depreciation shown in the liability side, or in the same asset side, in the inner column we subtract that accumulated depreciation and put the value in the outer column. That way it can be worked out. Let's see here, provision for depreciation. Provision for depreciation. So here, provision for depreciation by depreciation, right? For the first one, by depreciation. This value being 10,000. That's all. If I close the first year, we get a balance carried on of rupees 10,000. That 10,000 becomes as opening for the next year. Opening for the next year by balance brought down. 10,000. Second year again, I am going to calculate the depreciation 20 for the full year. Provision for depreciation by depreciation. Now the accumulated depreciation is 30. Isn't it? The balance in provision for depreciation being 30 here. To balance carried on. To balance carried on. Transfer to the next side. So by balance brought down. 30. Again, third year depreciation 20. Then the balance could be to balance carried on being 50,000. The balance could be 50,000. How this will appear in the balance sheet? Though it is not asked in the question, you will understand in balance sheet. For the first year, machine being 200. Provision for depreciation being 10. Second year, the machine will appear at 200. Provision for depreciation will appear at 30 because this is the balance carried on. The balance will go to the balance sheet. In the third year, machine will appear at 200. Provision for depreciation will appear at 50. And the net of this will be 190. The net of this being 170. The net of this being 150. That's the balance in the previous case. 190, 170, 150. Is that okay? You will get the same. Sir, why don't we subtract, sir? Why do I want to create that separately? If I ask that question, it's very simple. Depreciation is only an estimation. I'm not sure. How can you say that asset will be losing exactly this much of amount by the end of first year? It's a matter of an estimation, right? As it's a matter of an estimation, why do you then charge? You just keep it away separately. The original loss can be identifiable only on discarding it. On sale only you will be identifying. By the time adjust the provision, then beyond that if there is any differences, that will be treated as profit and loss on sale. So rather than adjusting that depreciation directly from the machine account as it's only an estimation, we can accumulate that in a new account called provision for depreciation. Provision for depreciation. So one of the beautiful model. Then what happens in the depreciation case? Depreciation case is the same. Depreciation is rather than subtracting from the assets accumulated in the provision, and then the depreciation is transferable to the P&L account as usual one. So provision for depreciation here, depreciation account, depreciation account. In this depreciation account, first case, to provision for depreciation 10,000, and this will be transferable to P&L account also by P&L account 10,000. First year over. Second year, repeat the same. To provision for depreciation 20. Depreciation is a nominal account. We don't have the balance at all. Whatever the balance we have will be transferable to the P&L account. And the last year means third year as per our provisions, our illustrations requirement. Provision for depreciation 20 by P&L account 20, it gets closed. It gets closed. Is that okay?